I want to start today by looking at a massive glitch in the financial architecture. Imagine a country hit by a once-in-a-generation disaster. A massive 9.0 magnitude earthquake, a devastating tsunami, and a nuclear meltdown. Half the country's industrial heartland goes dark overnight. If you asked anyone on the street what should happen to that country's currency, they'd tell you it should plunge like a stone. It's basic common sense, right? Except the market didn't care about common sense. Instead of crashing, the Japanese yen went absolutely vertical, tearing through historical highs and blindsiding short sellers around the globe. So, was this just market madness, or was there a hidden structural gravity at play? Why is it that in the FX world, when disaster strikes, the yen actually goes up? Today, we are breaking down the mechanics of the foreign exchange market. We're going to look at the biggest money printing game on Wall Street, how global capital actually moves, and why everything you learned in economics textbooks might be completely wrong. To understand currencies, we need to throw out the dense academic jargon and start with something we all look at every day: prices. If you've ever taken an economics class, you've probably heard of a concept called Purchasing Power Parity, or PPP. Strip away the textbook math, and it basically says one thing: a dollar should buy you the same amount of stuff anywhere in the world. Think about it. If you have $100 cash in Midtown Manhattan, you can buy a couple of decent meals, maybe a few rounds of drinks, and that's about it. But if you take that same $100, exchange it into local currency, and fly to an emerging market, you can live like royalty for weeks. That is a massive gap in price levels. Now, a textbook theorist might say, well, that's an arbitrage opportunity. If a latte costs $5 in New York but only 50 cents in Indonesia, why don't I just order 10,000 lattes from Indonesia and have them shipped over? Eventually everyone does that, prices equalize, and boom. That's how you calculate the fair value of a currency. In the real world, that is pure fantasy. Why? Because transaction and transfer costs are incredibly high. You aren't going to pay a $200 air freight fee for a $2 coffee. If you think real estate in London is insane and housing in rural Alaska is dirt cheap, you can't exactly pack up an Alaskan cabin and ship it to Mayfair. The truth is, the vast majority of our daily expenses, the roof over your head, your groceries, local labor, a haircut, cannot be easily traded across borders to eliminate price differences. Look at the European Union. They share a single currency and have zero tariffs, yet prices in Denmark are still more than double what they are in Poland. Throw in real-world tariffs, trade barriers, and capital controls, and the textbook version of PPP falls apart completely. So, we can't use daily prices to day trade currencies, but don't mistake a flawed short-term model for a lack of long-term impact. Over a long enough horizon, inflation is the ultimate anchor of the foreign exchange market. The first principle's logic is straightforward. If a currency is losing purchasing power rapidly at home, meaning high inflation, it becomes hot potato money. If nobody wants to hold it domestically, global investors certainly won't want to hold it internationally. Internal debasement guarantees external devaluation. Look at the long-term charts of currencies like the Indian rupee, the Indonesian rupiah, or the South African rand against the greenback. This structural decline isn't because these countries don't have economic growth. It's because they run chronically higher inflation than the United States. If your money melts at home, it devalues abroad. And if inflation gets completely unhinged, you get a front row seat to monetary tragedy. Look at the ultimate textbook case, Zimbabwe. By the mid-2000s, Zimbabwe's inflation was running at triple digits, then quadruple digits. Then it went completely off the rails. In 1998, $1 US bought you 24 Zimbabwean dollars. By 2006, that same single dollar bought you 100,000. So, the government decided to get creative. They performed a redenomination. They slashed 3 zeros off the currency. Suddenly, $1 US bought you 100 new dollars. Problem solved, right? Wrong. You can't fix a structural cash printing disaster with a typographical trick. Inflation went parabolic. By 2007, a dollar bought 30,000 of the new currency. By the end of that year, it was 2 million. And in 2008, the central bank printed the infamous $100 trillion note. At its low point, that $100 trillion bill couldn't buy you half a loaf of bread. It was worth less than 40 US cents. Citizens needed wheelbarrows of cash just to buy groceries. Within 3 years, the government chopped a total of 25 zeros off their money. Eventually, they simply ran out of letters in the alphabet to rename new versions of the currency, threw in the towel, and legalized the US dollar for domestic use. Inflation is the absolute unyielding floor of FX gravity. But if inflation is so powerful, why does the daily financial news focus so much on central banks, geopolitics, and yield curves, while barely mentioning consumer prices for pairs like the euro or the yen? Because for major economies, inflation usually fluctuates within a predictable, low-digit band. In that quiet zone, the heavy hand of inflation moves too slowly to see. It gets completely overwhelmed by a force that is much faster, much louder, and highly mobile. Interest rates. And remember, exchange rates are relative. What truly matters isn't just one country's inflation, but the inflation differential between two nations. If a global shock like the pandemic hits and every major country inflates their money supply at the same time, the relative exchange rates stay remarkably stable. The real volatility happens when the financial plumbing reacts to interest rates. If shipping physical goods across borders is slow and expensive, what is the cheapest, fastest thing to move? Capital. In modern finance, money is practically weightless. With a few keystrokes, billions of dollars can migrate from Tokyo to New York or London to Singapore in milliseconds. And when capital is looking for a place to park overnight, it doesn't care about long-term PPP models. It cares about one thing: yield. Global capital behaves like pure mercenary money. It has zero loyalty. It flies to whoever pays the highest risk-adjusted interest rate. If a central bank hikes rates, money pours into that currency to capture the yield, driving the exchange rate up. This is the essence of interest rate parity. Look at the recent massive run in the US dollar. The Federal Reserve aggressively hiked rates up over 5%. Global investors looked around and realized they could park cash in risk-free US treasuries and clip a clean 5% yield. Capital abandoned lower-yielding jurisdictions and flooded into the US, sent the dollar index soaring. This explains another massive paradox that trips up retail traders. Sometimes, a country prints a hotter-than-expected inflation report. According to our first chapter, the currency should drop, right? But instead, the moment the data hits the tape, the currency shoots up, wiping out the short sellers. Did the laws of economics break? No. You have to look at the short-term expectations game. The macro traders in London and New York aren't looking at the current purchasing power of the currency. They are looking at the central bank reaction function. They know that if inflation runs hot, the central bank will be forced to raise interest rates to cool the economy. The market trades the expectation of tomorrow's higher yield today. The anticipated rate hike is a violent, short-term force that can completely crush the underlying gravity of inflation. This is why the forces of inflation and interest rates are in a constant tug of war on your trading screens every day. This yield gap doesn't just sit there. It drives the single largest speculative mechanism in the foreign exchange market, the carry trade. And the undisputed anchor of this game for the last few decades has been the Japanese yen. For over 20 years, Japan fought structural deflation. Its economy was stagnant, and to fight it, the Bank of Japan anchored interest rates at 0% and even pushed them into negative territory. You literally lost money keeping cash in a Japanese bank account. Meanwhile, the rest of the world was running significantly higher rates. That created a massive, multi-percentage point yield chasm. If you are a macro hedge fund manager in Connecticut, or even a retail investor utilizing institutional leverage, this isn't a market puzzle. It's an open checkbook. Institutional money cracked the code. You borrow massive sums of yen at near zero interest costs, immediately sell that yen on the open market to buy US dollars, and use those dollars to buy high-yielding US debt. As long as volatility stays low, the Fed doesn't cut, and the Bank of Japan doesn't hike, you sit back and harvest a clean, leveraged yield spread. Because thousands of funds are running this exact same playbook, the market experiences a continuous, systemic wall of order flow, selling yen, buying dollars. This acts as a chronic, grinding devaluation mechanism for the yen. It's why between 2023 and 2024, the yen collapsed from 100 down past 150 against the dollar, forcing the Bank of Japan to spend billions in direct market intervention. It is a money printing machine until the music stops, because tucked inside this perfect speculative trade is a catastrophic macro time bomb. This brings us right back to our opening mystery. Why does the yen violently explode upward during a global financial panic or a domestic disaster? It comes down to a structural dynamic called the carry trade unwind. When a massive shock hits the global economy, asset prices crash and volatility spikes. Risk models across Wall Street flash red, and every major fund goes into survival mode. Their immediate priority is to slash risk and close down speculative positions. How do you close a carry trade? You have to run the film completely backward. To exit the trade, funds must liquidate their global investments, sell their US dollars, and buys back Japanese yen on the open market at any cost, because they owe that yen to the banks in Tokyo. Think about the sheer scale of the positioning. You have trillions of dollars of accumulated structural short positions in the yen. Suddenly, within a 48-hour window, every algorithmic fund and macro desk in the world rushes to the same exit door, screaming to buy back yen to cover their liabilities. The spot liquidity for the yen completely evaporates, and that forced short squeeze drives the exchange rate violently higher. This reveals the definitive law of a funding currency. It takes the stairs down during periods of calm, but it takes the elevator up during a global panic. This happened during the 2008 financial crisis, and it happened during the 311 earthquake in 2011. But notice something critical. The 2011 surge wasn't just about speculators unwinding trades. In 2011, global interest rates were already compressed near zero, meaning the carry trade wasn't the sole driver. Instead, the disaster triggered a massive wave of domestic repatriation. Japan is the world's largest net creditor nation. It holds trillions in overseas assets. When the earthquake hit, Japanese insurance giants and multinational corporations had to liquidate their foreign holdings and bring that capital home to fund disaster relief and reconstruction. It was the combination of a structurally strong macro environment, asset repatriation, and short covering that drove the yen to historic highs. It's not because Japan is a safe place during a disaster, it's because Japan owns the world's debts, and when a crisis hits, it calls those loans in. Beyond short-term capital arbitrage, we have to look at the structural reality of how a country interacts with the global economy. This is our third core driver, the balance of payments. Think of this as a country's macro financial ledger. It tracks whether a nation is a net importer or exporter of capital. The ledger breaks down into three nested layers that are often conflated in financial news. 1. The trade balance, the net value of physical goods exported minus goods imported. 2. The current account, a broader measure that takes the trade balance and adds services, tourism, and cross-border investment income. 3. The capital account, the largest bucket, which tracks net financial investments, FDI, and banking flows. For most nations, the absolute anchor of this ledger is trade. The fundamental logic is simple. If a country runs a structural current account surplus, it sells more to the world than it buys. To pay for those goods, global buyers must constantly buy that nation's currency on the FX market. Demand outstrips supply, creating a structural upward pressure on the exchange rate. Conversely, a structural deficit means a country is constantly selling its own currency to buy foreign goods, creating a natural devaluation headwind. Look at the contrast between the world's two largest economies. The United States runs a massive chronic current account deficit. It buys goods from every corner of the earth. But because the US dollar is the global reserve currency, foreign nations cycle those dollars right back into the US capital account to buy treasury bonds and US equities. These two opposing forces constantly battle, keeping the dollar in a complex, managed equilibrium. China, for decades following its entry into the WTO, ran a massive twin surplus, running a massive surplus in both the current account through manufacturing exports and the capital account through heavy foreign direct investment. This dual engine created immense upward pressure on the renminbi, driving a multi-year structural appreciation and allowing the central bank to accumulate over $3 trillion in foreign exchange reserves. That accumulation wasn't an accident, it was the direct structural consequence of a twin surplus ledger. We have now mapped out the fundamental pillars of the currency markets: inflation gravity, interest rate expectations, the carry trade, and the balance of payments ledger. But this raises a critical question. If the Bank of Japan knew that a skyrocketing yen would devastate its export-driven economy in 2011, why didn't they just run the printing presses and devalue it themselves? The truth is, they tried. In fact, in 2011, the Federal Reserve, the European Central Bank, and the Bank of England took the historic step of joining hands to launch a coordinated intervention to force the yen down. And yet, the market ran right over them. Because in the modern financial architecture, central bank announcements are just part of the story. Deep beneath the surface lies a shadow banking network that operates beyond national borders. In late 2014, the US Federal Reserve did not raise interest rates a single time, yet the US dollar index underwent one of the most violent, explosive rallies in modern financial history, crushing emerging markets and rewriting global macro strategy. It was a move driven by a force that ordinary investors completely miss. Next time, we are diving deep into the plumbing of the global financial system. We are going to unmask the central bank expectations game, look at the offshore euro-dollar market, and decode the hidden mechanisms that triggered the historic 2014 dollar short squeeze. We don't provide investment advice here. We just provide the high-definition lens to watch the chaos unfold. If you found this useful, or at least mildly depressing, feel free to subscribe. This was The Long View. Try to stay rational. I'll see you in part 2.